Hey guys, welcome back to the channel. In this video, we're going to unpack a lot of information about the stock market in relation to rate cuts, rate hikes, where I think the stock market may be going, short-term, long-term, what my plans are. So please, if you happen to like the video, if you get some information out of it, if you watch the whole thing specifically, like the video, subscribe to the channel if you haven't subscribed yet, leave a comment, let me know your thoughts and comments on this, and we'll just kind of go from there. So in the video today, we're going to kind of go through this article here. I'm going to link it in the description below that you can go fully read through and do your own research, which brings me to my next point. I'm not a financial advisor, guys. Make sure that you do your own research. Don't just follow me because of my opinions on here. Make sure that you do your own due diligence. You check out the charts, you read the articles and all that good stuff before you make any type of decisions and go from there. But we're going to go through this, guys. We're going to look at rate cuts in a couple of different specific time frames. What happened to the rate cuts in regards to the market? What did the market do once the rate cuts started? And what I may think, in my opinion, what I think that we may see over the next year or so in the stock market, and what I'm starting to kind of think about doing in regards to moving my money around in certain positions and things of that nature. So we'll just kind of go from there. So federal funds rate history 1990 to 2024, written by Michael Adams. Paul Katzeff was the guy who fact-checked it, apparently. Updated in May 20th, 2024 at 1:56 p.m. So this is fairly recent. And like I said, it's a good bit of information. So before we get too far into it, let's just talk about historically what happens when the Fed starts to cut rates and raise interest rates and things of that nature before we get too far down the line of this article. We all know who this guy is, right? Jerome Powell. And basically what's happened over the past couple of years is we've seen interest rates rise, okay, to battle inflation. And as the interest rates increase, supposedly it's going to help job creation in the market, all right, to basically combat inflation, bring it down, and the market slows down in certain areas such as lending money and people borrowing money, things of that nature. However, typically and historically, when they come in specifically for the first several rate cuts, what that can happen is it could actually cause a recession due to the increase in job losses, okay? And basically kind of allowing inflation to work itself out, things of that nature. And then you should slowly start seeing some improvement over time in the job market and things of that nature. So that's something to kind of keep an eye out moving forward. So the Fed has talked about raising interest rates whenever inflation got so high. They started raising interest rates, and then to kind of slow inflation down. Well, now that inflation is slowing and kind of stabilizing, however, you still see that prices are really high. When they say that the inflation is at a certain percentage, that's not saying that the prices are going down. It's saying that the prices are stopping from going up. So they're kind of bottomed out on, hey, it's still expensive, but they're just not maybe as high as what it could be next month. They're just going to kind of stay expensive where they are. Well, if they come in and they cut rates and we start losing jobs, well, that's going to hurt some people. That's going to hurt some businesses because people can't still afford to buy certain things. They can't go afford to buy a house, a car. They can't afford to buy as many consumer items and things. So that's going to where you may see some companies start to hurt, people pulling out of the market to get their cash, and where I think that it could affect the stock market, which we're about to look at as well. So back to the article, we're going to talk about understanding the Fed interest rate decisions. We're just going to read this little snapshot here and go down to some data. It says the Federal Reserve adjusts the federal funds target rate in response to what's happening in the economy. Adjusting rates help the Fed achieve conditions that satisfy the dual mandate, keeping prices stable and maximizing employment. Here's how that works. The Fed raises interest rates when the economy starts to overheat, too much inflation like we just talked about, and cut rates when the economy looks weak, high unemployment. Plenty of other data factor into the Fed monetary policy decisions, including gross domestic product, GDP, consumer spending, and industrial production, not to mention major events like a financial crisis, a global pandemic, or massive terrorist attack. Now, from all that, you're gonna see the data that they've kind of produced down below and we're going to take a look at that for certain years. We're going to take a look at the dot-com bust, okay, of when the Fed started decreasing rates, and then we're going to go back and look at that time frame in the market, and then we're going to look at the big financial crisis from 07, dating back to 07 when they started cutting rates, all the way to into 2009 to see kind of how it recovered. And I think everyone's pretty familiar with 2019, 2020, the COVID crash, and how things just went berserk after the fact. But let's take a look at that data really quickly. So this is the 2001 Fed rate cuts, the dot-com bust, and 9/11. Okay, so this is from January 3rd, 2001 to December 11th, 2001. As you see, basis points 50, 50, 50, 50, 50, and then they go to 25, 25, 50, 50, 50, and 25. So keep those numbers in mind. January 3rd, 2001, December 11th, 2001. And then we're going to take a look at 2007. As you see right here, this is where they're raising interest rates. 05, 06, the housing market boom. And then this is the rate cuts 07, 08, the housing market crash. So from 07, September 18th, 07 to April 30th, 2008, as you see the rate cuts there. Now keep those numbers in mind as we go look at the charts and we see exactly what the market did in that specific time frame. All right, guys, so here is January 1st, 2001 to December 31st, 2002. Okay, so as you see here, we're at an all-time high of the S&P 500 at 1383.37, and rate cuts start, and then look what happened. It's a steady downfall all the way down to 768.63. That's a 44% drop in price of the S&P 500. Okay, keep that in mind. Now going over to 2007 at 1576.09, rate cuts start coming in, and then we bottom out 666.79, and then as you see the recovery right here, we started coming in, and this was coming into 2009. We started kind of making our way back up, but as you see the cuts, how they affected, and we went into a recession, and then we had the big financial crisis, and then we came down pretty darn hard. Now fast forwarding to today, from 2022 January 1st to this past Friday, actually, we saw a drop in the markets. We bounced up, and now we're retesting at 56.69. So the thing here now is, do we continue to go higher, or is this just kind of like a head fake, and do we keep coming down, and is this the start of the big correction and big crash? Well, we don't know yet, right? So we're just going to have to kind of wait it out and play it out and see what happens. But if history repeats itself, then if the data is accurate and it correlates to the market, then we know that history is telling us that the first two rate cuts are going to have some type of effect on job loss, and in result, going to spook the markets and possibly slip us into recession. We don't know how long that will last for. So you could see some time of steady downfall of the markets. You know, historically speaking, if you're going off of the data and the trend of what it's done before. Now, some things to consider and things to think about is, you know, if you're in some positions that you're up in a lot, like if you bought some stuff down here, kind of like I did, like the individual stocks, particularly like Amazon, like Tesla, Nvidia, and some other plays, kind of considering maybe taking profits here and kind of sitting back or waiting and seeing if the market continues to rise a little bit higher, then taking profits and holding on to that cash and watching to see how we react to the rate cuts. And if the rate cuts happen and we start slipping down and we start coming down, then that'll create some really good opportunities to get back into the market. Also thinking of, if I can get that cash and then roll it over into the crypto markets, because that's going to have a positive effect on the crypto market in regards to rate cuts, is what I'm saying. Then taking those profits later, sometime next year, rolling them back into the stock market and capitalize on gains from there. So it's a lot to kind of think about, a lot to digest and kind of dive into your brain, I guess. But those are just kind of my thoughts and some things to keep an eye on. So I'm not talking about cashing out, you know, Roth IRAs or 401ks or anything like that. I'm talking about individual stocks that I currently have that I'm profitable in now, that I'm considering doing that for, and just kind of watching, if the crypto market's going to rip like people are saying, letting my money work in that aspect, and then take out my profits and then rolling it back into those plays such as Amazon, Tesla, Nvidia. Now the danger of that is obviously if I'm wrong and those stocks just rip to the upside and the market just continues to go haywire, then obviously you miss out on some gains from there, and you have to pay more money for them for the longer term. However, if you're right, then for sure that's going to be fully beneficial. But my plan also, like on IRA, pension, 401k, whatever, if the market gets kicked in the teeth and just falls and crashes or whatever, I'm not panicking. I'm just going to start dumping more into it, because whenever it starts to recover, it's only going to be more beneficial for the longer haul in that aspect. So I do want to touch base and talk about one stock in particular that we've talked about on the channel, and that I want everyone to keep an eye on moving forward, and that's Sasol, ticker symbol SSL. All right, so Sasol Limited currently at 838, and we've been talking about this one since it actually got into the sixes, and keeping an eye on it. Their earnings are coming up on, it should be, let's see if I can pull that up, if it's actually going to show me here, or they may have already had earnings. I think they had it on 820. I did get some information that the company is going to give bonuses for the employees, a 3% bonus as opposed to a 6% bonus as they usually do, but at least it's better than nothing. Like in 2020, they didn't give any bonuses. So could be a positive spike off of earnings and announcement that they're getting bonuses, that the stock flew up. But this one here, guys, I think longer term is going to get back into the 20s, maybe 30 range, especially if we get a change in administration. I think that's going to be bullish for this particular stock. So I'm keeping an eye on it right now. I have not bought any as of yet. I've been just kind of watching it, and then I should have bought because I watched it 6, went up to 7, or went up to 8, then fell to 7, watched, and then went back up to 8. It'll probably keep going, maybe all the way up to 10 before I decide to get in and just drop right back down. Who knows? But if it does happen to fall down again, then it gets into the 7s or the 6s, I'll probably start my position slowly adding. And I think they actually have a dividend on this stock as well. So this one here, pretty close to crossing over on the golden cross indicator. As you see here, these lines getting closer together right here. Once this blue line goes over the top, typically that signals we're going to see a spike in price, at least on the shorter term. So if this one pulls back and then rips back up again, you could see it go from like $8 to $10. But I like it longer term to get back into the 20s over the next 1 to 2 years. So anyway, guys, I know that's a longer video than normal, a lot to unpack, but let me know your comments below. Other than that, we'll catch you in the next one.